are we potentially looking at, maybe like a lost decade ahead of us for the average American household, or do you have a more sanguine outlook than that?
I think at least for asset prices, that's a really key risk. And so inflation was always the limiter, right? We've had a 40-year period of structural disinflation, lower rates, pushing up asset prices. Every sort of disinflation or deflationary event, the Fed could come in and liquefy markets. Fiscal stimulus could come in and liquefy, the consumer, especially in 2020. And with inflation as high as it is, those tools start to have visible costs to them. And so I think that's the thing going forward. And going back to the point about, to what extent the stock market versus the credit markets versus recession kind of, impacts Fed policy. I think one way I look at it is that, the stock market going down is by no means a trivial matter, especially for an economy with a twin deficit that's so reliant on consumer spending. It's that I think that, Jerome Powell can't get up in front of Congress and say stock prices down, so we have to, be more dovish. It's that the stock market going down eventually leads into credit markets going down, eventually, causes that cascade where then something breaks and Powell has to come in and be like, due to, recession indicators, we have to, be more dovish. And so I do think that, kind of my risk outlook for the 2020s, not just the year ahead, but just in general, is those more stagflationary types of environments, monetary policy alone not being enough, and contention within fiscal policy about how to best deal with it. I think that there are some bipartisan issues they can explore, like, for example, payroll tax cuts, for example. You would think that that'd be somewhat bipartisan because Democrats could use it to, support labor, and Republicans can use it to support tax cuts. But you don't really see that type of kind of common sense policy. Instead, you have kind of the pork and the debates they have in other areas. So I think that they have tools available to them if kind of cooler heads prevail. But given just fiscal deficits where they are, inflation where it is, debt levels where they are, I do think overall that this is more of a decade of payment rather than those tailwinds continuing.
All right, if you're an investor watching this who's concerned about the major trends and macro risks that you guys have elaborated on here, where are potential, asset sectors, et cetera, that you might encourage them to consider looking at?
I've been fairly bullish on healthcare and consumer staples and some of these kind of non-cyclical value areas. In addition to energy producers, I like the energy transporters, the higher quality ones with decent credit scores and good handle on their debt. Because I don't think we're gonna, U.S. energy policy, given high oil prices, I think some of the pressure on some of the producers is maybe waning to some extent, and supply, looks pretty good for some of those pipeline companies. I do echo gold as a pretty good environment, especially as as the economy continues to decelerate, as you see PMIs roll over, as you see leading indicators roll over, gold looks pretty well positioned in this environment. And then emerging markets are one of my kind of risk on areas. I've been liking Brazil. I've been liking some of these other markets for the kind of the riskier side of my portfolio. And I think as you eventually trow and then turn up, you can look at things that were drastically oversold. So I do think that Russia could be attractive. I think some of the oversold growth stocks could be attractive. In the next rising PMI environment, I'd be bullish on Bitcoin again. So I think there are, a bunch of different kind of layers depending on how far you want to look out on this. But I think the era of broad U.S. large caps going up is somewhat more challenged going forward than it has been over the past 10 years, and then more broadly over the past 40 years.
Okay. Real quick before I get to you, Ivy, on real estate, just toss a question out to anybody who wants to answer it. I guess two questions. One is, how concerned are you about a substantial market correction in the relatively near future? And by relatively near future, I'll say the next 12 months, right? It could happen at some point in 22 or early in 2023. And along with that, how do you feel about cash right now as a position in a portfolio? And I'll let anybody chime in on that if they want.
I'll hop in real quick just to continue. So I think, as long as we're in this declining PMI, declining, leading indicator environment, I think we are at risk of ongoing correction. I don't think it's very favorable for asset prices. I'm not maybe as bearish as some of the outright bears out there because you're measuring it in a currency that I think is going to devalue significantly over this decade. But you can certainly have these air pockets where you go down 20%, 30%, maybe more. So for that reason, even though I've often joked that cash is like the most speculative asset that I own because it's something that I hold knowing that it's going to lose value, but that I hold it anyway because I'm kind of speculating that some of my other assets that I actually want to own might lose value more in kind of a near term, kind of 6 to 12 month period. So I do use cash as a volatility reducer, a rebalancing tool in this environment. So I think that you go forward, you have 7% inflation, you have roughly zero yields. Some types of assets have a little higher yields. You're getting devalued. But if you have stocks go down, notably, then cash ends up outperforming for a period of time. So I'm not particularly bearish on cash with a 6 to 12 month view.